Welcome to the Deep Dive. Today we're tackling a really fascinating and, let's be honest, pretty volatile name in real estate tech. Opendoor Technologies. Ticker symbol OPEN. Yeah, we've got this detailed research report dated October 21st, 2025, and it maps out Opendoor's wild ride. I mean, a decade of huge growth, but also, wow, some staggering losses. So our mission today is really to cut through all that noise. We want to figure out, is Opendoor genuinely the future of how we sell homes? Or is the whole iBuying model, well, maybe fundamentally flawed, maybe just a product of that zero interest rate era?
It's definitely a high-stakes question, and we've synthesized a lot of data for this deep dive. We're covering everything, their core business, the financials, the market sentiment, which is all over the place.
Okay, so 7 chapters in total, covering the business right through to the risks.
Exactly. But look, before we get into the weeds, I think we need to set the stage with just how, well, irrational the current market seems. I'm going to give you the punchline right up front.
Okay, hit us with the hook. The stock's trading around, what, $7? Why should people really tune in for this one?
Because as of October 20th, the share price was $7.37.
Okay.
But when professional analysts actually run the numbers using intrinsic valuation models, looking at cash flows, fundamentals.
Right, the boring stuff.
Yeah, the boring but important stuff. Their estimated true value for Opendoor, it's somewhere between $1.50 and $2.50 per share.
Well, hang on. $1.50 to $2.50 versus over $7.
Exactly.
That implies
What?
over 80% potential downside.
That's what the fundamentals suggest.
So the market is just completely ignoring the numbers right now. It sounds like the stock's running purely on hope, on some kind of narrative.
That's precisely the disconnect we need to explore. It's a massive gap. So we need to figure out what is that narrative and, crucially, does it actually hold any water?
Okay, let's dive in.
Let's start with the core business itself, the reality on the ground.
Right. Part 1. The core business and health. Let's kick off with Chapter 1, Business Understanding. Opendoor really pioneered this whole iBuyer model, the instant buyer concept. Can you just quickly walk us through how that actually works for someone selling their house?
Yeah, sure. It's all about tech and speed. They use these proprietary algorithms, AVMs, they call them automated valuation models.
Right.
These crunch just tons of data to spit out a near-instant all-cash offer. And they're really targeting, homes that just need some light repairs, things they can turn around quickly. Volume is key.
So the appeal for the seller is?
Oh, it's huge. It's simplicity, certainty, and speed. You get to skip the open houses. You avoid buyers whose financing might fall through. No contingencies.
Yeah, all that stress.
Exactly. And they promise a closing often within 2 weeks. It's fast.
Okay, fast and simple. But how do they make money doing this? What are the revenue streams?
Well, there are 3 main ways. First, there's the service fee. It's usually between, say, 5% and 8%.
Roughly comparable to traditional agent commissions then.
Pretty much, yeah. Second, there's what they call the spread. That's the profit they make by essentially buying the house a bit low and selling it a bit higher after doing those light repairs.
Okay, the classic flip margin.
Right. But what's interesting and maybe a bit concerning is that the FTC investigated them back in 2022.
Oh yeah, I remember that.
And the FTC found that this spread, buying low, was actually a key profit driver, even though Opendoor's marketing was kind of suggesting sellers would make more money with them than on the open market.
Right, that led to that big $62 million settlement for deceptive marketing, didn't it?
It did. So that's definitely a regulatory shadow that hangs over them. It highlights the tension in their model.
Okay, so service fee, the spread, what's the third stream?
Ancillary services. Things like title insurance, escrow services. They pushed into this vertically after buying a company called OS National back in 2019. These tend to be higher margin services.
Got it. So with Zillow Offers and Redfin now out of the iBuying game, Opendoor is the big fish now. What's their real competitive advantage? What stops someone else just copying them?
Yeah, that's the crucial question. It really comes down to their proprietary data moat.
Data moat. Explain that.
Every single time they buy and sell a house, they collect unique data. Not just market prices, but detailed stuff. Interior photos, videos, precise costs for specific repairs in specific neighborhoods for specific types of houses.
Stuff you can't just scrape off Zillow.
Exactly. And all this data feeds back into their AVMs, their pricing algorithms, making them smarter and more accurate over time. It creates this self-reinforcing loop that's really hard for a newcomer to replicate without that transaction history.
Okay, so the data is the core asset. That makes sense. But there's also regulatory risk beyond that FTC settlement, right? Like the whole NAR commission lawsuit stuff.
Yeah. Well, it's an indirect threat. The DOJ scrutiny of the National Association of Realtors and the traditional 6% commission structure. If that gets blown up, it could disrupt the whole landscape Opendoor operates in, even if they aren't directly targeted. It changes the baseline comparison for their fees.
Interesting. Okay, let's shift gears to the people running the company. Chapter 2, Management Evaluation.
Right. The report points out that management's track record, historically, has been pretty reactive, reacting to housing downturns. They've had 3 big rounds of layoffs, 2020, 2022, and 2023.
And the CEO situation changed recently, too.
Yeah, the former CEO, Carrie Wheeler, stepped down just last month, September 2025. Seems like there was some shareholder pressure there.
Okay, so that sets the stage for this turnaround narrative that seems to be driving the stock lately. A big part of that is the new CEO, right?
Absolutely. They brought in Cos Najation. He was the chief operating officer at Shopify.
Shopify, that's a very different business. Tech, platform, capital light.
Exactly. And that appointment signals, or is meant to signal, a pivot. A shift towards Opendoor becoming more of a technology and product-led company, maybe less like just a giant house flipper relying purely on market timing.
And the founders are back, too.
That's the other key piece. Co-founders Keith Robois, he's now chairman, and Eric Wu, they've rejoined the board. That return of the original founder DNA, that really lit a fire under the stock, especially with retail investors. It's a powerful story.
But like you said, Shopify is capital light. Opendoor is the opposite, incredibly capital intensive, needs tons of debt to buy houses. How does that Shopify experience translate?
Well, that is the multi-billion-dollar question, isn't it? Historically, Opendoor's strategy has been all about aggressive capital allocation towards inventory, just buy more houses.
Right.
But if you look at the financials, which we'll get into more in the next chapter, the big flashing red light is the return on invested capital, the ROIC.
Okay, what's the story there?
The story is, it's bad. The ROIC has been consistently deeply negative. We're talking numbers like negative 2.68% down to negative 13.48% in some periods.
So for every dollar they invested in buying home,
They were actually destroying value, historically speaking. The capital they deployed just wasn't generating adequate returns to cover its cost. The new CEO has to fix that, fundamentally change how they allocate capital.
yet the insiders seem pretty bullish on this new direction. The report mentions strong conviction.
Undeniably, you've got Robois' venture capital firm and Eric Wu personally putting in another $40 million. Plus, the new CEO, Najation, got this huge performance-based stock grant RSUs tied to hitting some very ambitious stock price targets.
Okay, so they're putting their money where their mouth is, literally.
It sends a very strong signal internally, yeah. We believe this turnaround is real.
All right, let's get into those hard numbers then. Chapter 3, Financial Analysis. This is where the fragility really shows up, isn't it?
It is. Look at the revenue trend. It just perfectly mirrors the housing market roller coaster. Exploded in 2021 to $8 billion, then $15.6 billion in 2022.
Wow.
Then bam, interest rates go up and revenue crashes 55% in 2023 down to just under $7 billion. Extreme volatility.
And profitability. Has there ever been a profitable year?
Nope. That's the killer stat. Opendoor has never reported a profitable year. They lost almost $400 million just last year in 2024.
Never profitable after a decade. And you mentioned the margins earlier.
Yeah, razor thin. Gross margins are only around 8%, maybe 8.4% in a good period.
So for every $100 in revenue, only about $8 is left after paying for the house and fixing it up.
That's right. And out of that tiny $8 slice, they have to cover everything else. Salaries, marketing, tech development, office space, and critically, the interest on all their debt. There's just very little cushion.
Okay, speaking of debt, let's talk about the balance sheet. The report highlights a debt-to-equity ratio of, what was it, over 300%.
Yeah, 344.8%, which translates to a 3.45 to 1 ratio.
So help us understand that. For every dollar of actual shareholder equity, they're using almost $3.50 of debt.
Exactly. It shows extreme leverage, which means extreme financial risk. In a low-rate environment, leverage can juice returns. But when rates are high, like now, that leverage becomes an anchor. The interest expense can just crush you.
Which makes that high current ratio kind of misleading, doesn't it? The report said it was strong, like 4.35, suggesting liquidity.
It's a paradox, yeah. Normally, high liquidity is good, but so much of Opendoor's current assets are tied up in housing inventory, houses they own.
Which aren't exactly like cash in the bank if the market turns south.
Precisely. If the housing market slows down or prices drop, that inventory becomes less liquid, harder to sell quickly, and its value can plummet. They could face massive write-downs, wiping out that supposed liquidity cushion overnight.
Okay, this all circles back to that huge valuation disconnect. Chronic losses, massive debt, thin margins. Why on earth is the stock at $7.37?
Because the market isn't pricing the past, it's pricing a future, a potentially massive turnaround. But yeah, the discounted cash flow model, the DCF, paints a very, very different picture.
And you mentioned they used a high discount rate for that DCF.
A very high rate, 11.5%.
Why so high?
Because that reflects the perceived risk. Professional analysts see Opendoor as extremely risky because of the leverage, the cyclicality, the lack of proven profits. You have to demand a higher potential return to compensate for that higher risk.
And using that high risk rate, the DCF model spits out
An estimated intrinsic value of just $1.50 to $2.50 per share.
wow.
So yeah, the current stock price is basically pricing in a miracle turnaround and a favorable market environment.
Which brings us neatly to part 2, market forces and risk.
Exactly. Starting with Chapter 4, Market Sentiment. This is where the story gets really wild.
That disconnect between, say, a baller MIDI 50 and a fundamental value and $7.37 in market price says it all.
It does. And look at the analyst community. Overwhelmingly bearish. You see mostly reduce or hold ratings. The average 12-month price target from analysts is somewhere between $1.14 and $1.27.
Wait, $1.14 to $1.27 for a stock trading over $7.
Yeah.
So basically every major Wall Street analyst covering the stock thinks it's going to crash, potentially by over 80%.
That's what their targets imply, yes.
So what is holding the price up? Who is buying?
It looks and smells very much like a meme stock situation right now. The price seems entirely disconnected from fundamentals and driven by, social media hype, retail investor enthusiasm.
Fueled by that turnaround narrative, the new CEO, the founders returning.
Absolutely. It's a powerful story. So you have this classic tug-of-war, retail speculation and narrative driving the price up, while institutional skepticism and fundamentals are screaming caution.
And the technical charts show that enthusiasm, right? Trading above key moving averages.
Yeah, technically the stock has reversed its long-term downtrend. It's trading above both the 50-day moving average, which was around $6.64, and importantly the 200-day, which was way down at $2.53. That signals a major trend shift, technically speaking, based purely on this recent narrative momentum.
And you can't ignore the short interest here either.
No, it's critical. Short interest is very high. Over 21% of the public float is held short. That's more than 150 million shares betting against the stock.
Which means?
It means there's huge potential for a short squeeze. If the stock keeps rising, or if they deliver any positive surprise in their upcoming earnings report, which is November 6th, by the way, a huge near-term catalyst,
Right.
then those short sellers might be forced to buy back shares to cover their positions, driving the price even higher, even faster. It adds another layer of volatility.
Okay, let's look at who actually owns the stock. Chapter 5, ownership structure. Institutions hold almost half.
Yeah, about 47.2%. But there's a really interesting split happening within that institutional ownership.
How so?
The big passive index funds like Vanguard and BlackRock, they've actually been trimming their positions, reducing risk exposure to Opendoor.
Okay.
But at the same time, you have more active managers, hedge funds, specialized funds who have been initiating new positions or significantly increasing their stakes.
So the passive money is getting cautious, but the active money is making a specific bet on the turnaround.
That's exactly what it looks like. They're making a catalyst-driven bet that this new leadership and strategy will actually work, and they want to be in before the potential pop.
And again, underpinning that bet is the insider confidence.
It keeps coming back to that, doesn't it? Co-founder Eric Wu didn't just rejoin the board, he went out and bought over 750,000 shares on the open market with his own money.
That's a big personal bet.
It's huge. Combine that with the new CEO's performance stock units tied to massive share price appreciation. It sends a very clear signal from inside the company. We genuinely believe we can turn this ship around.
Okay, final reality check time, Chapter 6, risk assessment. Let's pull together the key vulnerabilities. Internal weaknesses first.
Well, we've hit them already, but to summarize, number 1 is chronic unprofitability. They just haven't proven the model works financially through a full cycle. Number 2 is that extreme leverage, the 344.8% debt-to-equity ratio, massive financial risk. And number 3 is just their inherent sensitivity to the housing market cycles.
Okay, weaknesses, any opportunities?
Sure. The report mentions potential expansion into new markets. They're in over 50 now, but there's still room to grow. And maybe diversification into more capital-light models, like partnering with traditional agents rather than buying every house themselves. That could reduce balance sheet risk.
But the big risks are external, the macro threats.
Overwhelmingly, yes. And the single biggest one, the absolute killer variable, is interest rates.
We keep coming back to that. Why is it such a threat?
Because high rates hit Opendoor from multiple angles simultaneously. It's like a triple threat. One, it increases their own cost of borrowing money to buy inventory. Their debt gets more expensive. Two, it crushes housing affordability for the end buyer, making it harder and slower for Opendoor to sell the homes they do own. Transaction volume dries up.
Okay.
And three, high rates can actually cause overall home prices to fall. If that happens, Opendoor gets stuck holding inventory that's declining in value, forcing them to take potentially huge losses.
So higher borrowing costs, slower sales, and falling asset values. Ouch.
It's a brutal combination for their model. And even things like persistent inflation or potential future tariffs add pressure.
How so?
Well, if inflation stays high, the Fed is forced to keep interest rates high, continuing that triple threat. And imagine if, say, new tariffs were placed on construction materials, steel, lumber, that would directly increase Opendoor's renovation costs on the homes they flip, squeezing those already razor-thin 8% gross margins even further.
The entire business model just seems incredibly exposed to factors outside its control.
It really is a hostage to the macroeconomic environment, particularly the housing cycle and interest rates.
Okay, let's bring it all together. Chapter 7. Conclusion. We need to synthesize this. Let's start with the definitive bull case. What's the argument for owning Open at $7.37?
Right, the bull case. It's entirely forward-looking, it's narrative-driven. You're betting on the new leadership, the Shopify guy, the returning founders to execute a brilliant strategic reset.
Leveraging that data moat.
Exactly. Leveraging the data moat, expanding smartly, maybe finding more capital-light revenue streams. They operate in a huge, underpenetrated market, disrupting traditional real estate, and critically, if or when interest rates eventually start to fall.
That headwind becomes a tailwind.
A massive tailwind. Opendoor is perfectly positioned, given its leverage, to potentially ride that wave to explosive growth if the market turns favorable again.
Okay, that's the optimistic view. Now, the equally compelling bear case.
The bear case is grounded in history and facts, a decade of operations and still no profits. That suggests the core iBuying model might just be structurally unprofitable, or at least unproven through a full cycle.
And the risk.
Extreme financial risk. That 344.8% leverage makes them incredibly fragile, especially in a downturn. Their fate is almost entirely tied to the housing cycle, which they don't control. And fundamentally, you have that glaring valuation disconnect.
The $1.50, $2.50 intrinsic value versus the $7.37 market price.
Right. The current price isn't just pricing in a turnaround, it's pricing in a flawless turnaround happening while navigating massive macroeconomic headwinds. The margin for error is basically zero.
So bringing it home for you, the listener, what's the bottom line here?
Look, an investment in Opendoor at $7.37 today isn't really an investment based on current fundamentals. It's a speculative bet. It's high risk, potentially high reward.
You're betting on.
You're betting on the new management team executing perfectly. You're betting on them restructuring this capital-heavy business successfully. And you're betting on the housing market recovering favorably, probably sooner rather than later. If that narrative breaks, if execution falters, or if rates stay high.
There's no fundamental floor anywhere near the current price to catch it.
That's the risk. The downside could be very significant, aligning more with those fundamental valuations.
Okay, before we wrap up, here's a final provocative thought for you to chew on. Something that wasn't explicitly in the report, but builds on it. We talked about the data moat being Opendoor's only truly defensible advantage, right? That AI pricing engine.
Yeah, definitely their crown jewel.
So how much is that data, that technology alone worth? What if Opendoor pivoted completely? What if they became a capital-light company licensing that proprietary pricing tech to other real estate players instead of putting their own balance sheet at risk buying houses?
Shifting from iBuyer to like a data as a service model for real estate.
Exactly. Something to think about, especially with a product-led CEO from Shopify now at the helm. Anyway, if you found this deep dive valuable, please do like and subscribe to Stock Analytics AI. Seriously, it helps us a lot. And remember, for just $4.99 a month, you get access to our full playlist. That's 500 deep dive videos covering all the S&P 500 stocks.
And we're rolling out exclusive coverage of the NASDAQ 100 next, just for members.
Plus, members can request deep dives on specific stocks. Just drop the ticker symbol in the comments on any video and we'll get on it for you.
And now, the important reminder. This analysis was generated by an AI system. It's for educational and informational purposes only. It is absolutely not financial advice.
Please always consult with a qualified human financial advisor before making any investment decisions. Your own circumstances matter.
Definitely. Do your own homework.
Okay, that's all for this session. We'll see you next time on The Deep Dive.